What if this is the year that $10,000 changes your life? Imagine taking just a few smart steps in 2026 and watching your money grow, maybe double, maybe triple, while you sleep. Let's count down the top 10 best ways to invest $10,000 this year, from safe bets to high-growth picks, even if you're starting from scratch. Thanks for joining us. We break down investing ideas without the jargon so you can grow your money safely. Disclaimer: not financial advice. Always conduct your own research. Ready? Okay, let's dive into our 2026 countdown. Number 10, high-yield savings accounts and CDS current yield growth. 4.6 to 5.2% APY for HYSAS, up to 5.4% 1 to 2 year CDS. Why good in 2026? Rates remain high as inflation persists. Great for emergency funds. Virtually zero risk. Example: $10,000 at 5% annual yields $500 in a year. Major risks: inflation may outpace returns. Rate drops possible, not for long-term wealth building. Action tip: check SoFi or Ally Bank for top HYSA rates. Shop around. Rates change month to month. Estimated return: approximately $500 per year on $10,000. Number 9, U.S. Treasury Bonds and tips. Current yield growth 3.5 to 4.5% for short-term treasuries, approximately 3.4% for tips. Why good in 2026? Steady income and inflation protection. U.S. Treasury seen as safest bet if uncertainty rises. Example: $10,000 in tips at 3.4% returns $340 plus inflation adjustment. Major risks: yields may drop if rates fall. Risk of missing out on higher return assets. Tips prices fluctuate with rates. Action tip: use ibonds.gov or brokerage for Series 1 bonds. Buy fractional bonds via Schwab or Fidelity. Estimated return: $340 to $450 per year on $10,000 before inflation bumps. Number 8, certificates of deposit, CDS. Current yield/growth, 5.0 to 5.4% for 1-year CDS. November 2025 rates. Why good in 2026? Fixed yield in a turbulent market. Protects against interest rate swings. Example: $10,000 in a 1-year CD at 5.2% nets $520 after 1 year. Major risks: early withdrawal penalties. Rates could jump after you lock in, not as liquid as savings. Action tip: ladder your CDs. Spread money across several maturity dates for flexibility. Estimated return: $500 to $540 per year. Number 7, investment-grade bonds and bond ETFs. Current yield growth, 4.4% average yield in 2026, U.S. investment grade. Why good in 2026? Market expects rate cuts. Bond values likely rise. Adds portfolio stability. Example: $10,000 in AGG ETF, aggregate bond fund, earns approximately $440 in yield, plus potential price gain if rates drop. Major risks: interest rates could rise further. Bond funds aren't FDIC-insured. Returns may not beat inflation. Action tip: use broad bond funds like AGG or BND. Automate investing with a robo-advisor if new. Estimated return: $400 to $500 per year. Number 6, real estate investment trusts, REITs. Current yield growth, 4 to 5% average yield, plus price rebound potential greater than 6.2% total return forecast. Why good in 2026? Real estate values stabilizing as rates normalize. Dividends paid quarterly, easy diversification. Example: $10,000 in VNQ, Vanguard Real Estate ETF, yields approximately $420 in dividends. Major risks: sensitive to rate changes, sector downturns, not as liquid as stocks. Action tip: try fund options like VNQ or SCHH. Reinvest dividends for compound growth. Estimated return: $400 to $650 per year, including dividend and potential price lift. Number 5, S&P 500 index funds, and broad ETFs, current yield charge growth, 7 to 8% long-term expected growth. 2025 to 2035 projections, approximately 1.5% dividend yield. Why good in 2026? Built-in diversification. Low fees, strong post-bear market momentum expected. Example, $10,000 in VOO/IVV returns approximately $800 in a good year, $700 in average years. Major risks. Market drops can lead to big short-term losses. Emotional investing can cause panic selling. Returns not guaranteed. Action tip. Use dollar cost averaging, automate monthly buys, to smooth out market ups and downs. Estimated return, $700 to $900 per year, averaged. 4. International and emerging markets funds. Current yield. Growth, 7.3 to 8% projected for emerging markets. Global ex-US average 7.6%. Why good in 2026? Faster GDP growth outside the US. Currency diversification, potential outperformance as US valuations peak. Example, $10,000 in VWO, Emerging Markets ETF, at 7.3% equals $730 growth or more in high return years. Major risks. Currency swings, political risk, volatile short-term swings. Action tip. Limit to 15 to 25% of your portfolio unless you love risk. Use low-fee funds like VWO or EFA. Estimated return, $730 to $800 per year, averaged. Number 3, target date or life cycle retirement funds. Current yield growth, 5 to 7% averaged for 2026 to 2050 cycles. Why good in 2026? Auto diversification and risk management. Adjusts from stocks to bonds as you age. Set and forget. Example, $10,000 in a 2065 fund grows approximately $650 per year, 6.5% over time. Asset mix rebalances for you automatically. Major risks, fees a bit higher, approximately 0.08 to 0.25%. May not suit DIY investors wanting control. Underperformance possible if misaligned with risk profile. Action tip. Pick a fund closest to your anticipated retirement year, e.g. 2065 if young. Available at Vanguard, Fidelity. Estimated return, $600 to $700 per year, averaged. Number 2, dividend growth stocks and ETFs. Current yield and growth. 2 to 4.5% average annual yield, with 7 to 10% total return expected long-term. Why good in 2026? Dividend payers may shine if the economy slows. Many raise dividends yearly, fighting inflation. Example, $10,000 in VIG, Vanguard Dividend Appreciation ETF, yields approximately $320 and could gain another $500 to $700 if market grows. Major risks. Single stock investing has high risk. Dividends can be cut. Stocks can drop in value. Action tip. Use ETFs like VIG, SCHD, US, or VYMI, International. Reinvest your dividends. Estimated return, $700 to $1,000 per year, total return. Number 1, broad growth ETFs, e.g. Tech, S&P growth, current yield, growth. 9 to 12% expected annualized growth for U.S. growth ETFs, 8 to 9% for global tech funds. Why good in 2026? Tech innovation, AI, and healthcare leading the next bull market. Outperformed all other sectors in 2024 to 2025. Example, $10,000 in VUG, Vanguard Growth ETF, at 10% equals $1,000 return in an average year. Major risks, high volatility, steep drawdowns in a bear market, heavy sector concentration. Action tip, limit to 10 to 30% of total portfolio for balance. Look for low-fee options, VUG, QQQ, VGT for tech. Estimated return, $900 to $1,200 per year, averaged. Bonus section, getting started, fractional shares, compounding. Worried you need a ton of cash? You don't. Nearly every platform now lets you buy stocks, ETFs, even bonds in fractional shares. You can start with as little as $5. Just search for this option on apps like Robinhood, SoFi, or Fidelity. Compounding calculator example. If your $10,000 grows at 8% for 15 years, no additional deposits, you end up with nearly $32,000 just by staying invested. Common beginner mistakes: chasing hot stocks, panic selling after drops, ignoring fees, not diversifying, putting it all in one asset or meme coin. Let's look at the actual math on screen right now. $10,000 at 8% compounded annually. Year 5, $14,693. Year 10, $21,589. Year 15, $31,722. That's over 3 times your money doing absolutely nothing but waiting. There are 100 ways to invest, but these 10 are proven, beginner-friendly, and built for 2026. Which one sounds best to you? Drop your pick in the comments and share why. If you learned something, smash the like button and subscribe for more action-ready investing guides. Ready to start?